Welcome to Money Veterans. I'm Monica. Today we explore global macro dynamics between major economic regions and how they shape long-term positioning across equities, digital assets, and emerging markets. This content is educational and focuses on strategic frameworks. Let's dive in. Chapter 1. Financial Markets. There were positive news on financial markets this week. Earnings at Wall Street are above average so far for 75% of companies. Shutdown should be solved according to Kevin Hassett, Director of National Economic Council. On the tariff side, Secretary of Treasury Scott Bessent said tensions with China had eased. Finally, the market is whispering a rate cut from the Fed. Outside of the US, Sane Takaichi has been confirmed as Prime Minister in Japan. We will make soon a video on Japan, an interesting place to invest according us. Gold price has receded after a record above 4,000 USD. We keep a close eye to gold. Actually, it is a bit overbought and we are waiting for a correction. We keep you posted. Concerning the crypto market, there was a shy rebound after the crash of 21st of October. Don't forget the absolute limit for BTC. This is the zone 102,000 USD, 104,000 USD that must absolutely hold, otherwise this would be the big crypto crash. Another point, still no rally for the altcoins. And there shouldn't be. Why? 1. Most people have no money because of inflation. 2. BTC is catching all the money from investors with the ETF BTC. 3. The rest could go in other ETF crypto like ETH and SOL, but not in small altcoins. 4. The only way to have a rally in alts would be a stimulus plan with a paycheck given to the American people like in 2021. 5. Some people think it could be possible with the money coming from the tariffs, but there are many conditions. We stick to big crypto like Ethereum. Ethereum will survive because it has a real utility and the critical mass. Concerning Chapter 2, portfolios, we didn't make any trade on our portfolios this week. We just show you the detailed composition of our portfolios in the description of the video. And now, let's talk about the US-China trade war. I let Maya presenting you the Chapter 3 ideas and themes. Please have a look. I'm sure you will learn a lot of things. Bye-bye. See you.
Chapter 3. Ideas. Thank you, Monica. Hello, everyone. My name is Maya, and I am your host. We have briefly seen the quadrant, then Mikhail Porter 5 forces. Today we explore US and China relationships. Entry of China in WTO in 2002 was decisive for both countries. At that time, this was a mutual benefit. United States could buy cheap products coming from China at a low price, while China could strengthen its economic development. It was a win-win situation for both. Moreover, the Chinese were recycling their proceeds from exportations into US Treasury bonds. The United States had also found a way to finance their deficit. Silently and wisely, China began to reconstitute the new Silk Road that existed in the Antics, meaning a considerable Chinese power in Asia. To that extent, China has built many infrastructures in Asia, giving considerable amount of money to its neighbors to finance their infrastructure. But it was also a way to increase their dependency to China, because China was often lending them the money, sometimes at a high level of interest rates. The win-win situation with the US lasted for many years, until the Chinese began to realize they could develop their economy on their own. Maybe it was scheduled at start, we don't know. In the meantime, the bargain was also less profitable for the US. Americans were complaining about jobs created in China rather than in the US, and the dependency to China was dangerously increasing. Relationships changed during recent US administrations. Today we see the continuation of the rivalry between the two empires. We would like now to emphasize 3 weaknesses in China, often mentioned as 3D. What means 3D? Debt, deflation, demographics. 1. Debt. Official debt for China represent 88% of the GDP, compared to 121% for the US. But be careful, the devil is in the details. 88% is the level contracted by the central state, but it does not take into account the private debt. This private debt is estimated to 192% of the GDP, with a total public plus private debt around 300%. However, if you take the same calculation for the United States and the European Union, you realize the US are indebted at 400% and the EU at 265%. See the graph, data in 2025. to deflation. This is one very interesting characteristic to look at when you study the Chinese economy. Please listen carefully, you will be certainly surprised. Indeed, Chinese people have rebuilt their economy for the last 25 years, but they always fall in the same trap. Chinese economy is very competitive, and there are always a lot of plants, factories producing at full speed. The Communist Party gives the guidance for certain sectors, and immediately there are a lot of producers. It happened for solar panels, steel, EV, batteries. Each time they are in overcapacity. The overcapacity for the Chinese economy is structural, something to have in mind. As there is too much production, prices fall, as well as profitability. Last news, at the end of October, the Communist Party will communicate its guidance for the 5-year plan. We will keep you posted to see if one specific sector is mentioned. 3. Demographics. A lot of analysts always mention demographics as the Achilles heel for China. However, we are more measured on this subject. Today, Chinese population is 1.4 billion people, same as India. It should decrease indeed, but there are ways to compensate. The law on number of children has been changed. Workforce is educated and can improve its productivity with robotics and AI. Diminishing the workforce can compensate the overcapacity problem. A full video would be necessary. Currently, we spot this issue, but according to us, the overcapacity is really the dominant issue. Conclusion. The US-China war has started around 8 years ago and should continue until 2035, according to a panel of specialists. This is a critical issue for our portfolios. As you may notice, we are invested in emerging markets rather than in the US. It does not mean we are favoring China. It is a decision made on current earnings and valuations. There is not only China. It is important to follow closely the BRICS Plus initiative. There are Brazil, Russia, India, China, South Africa, as well as new countries admitted in 2024, Egypt, Ethiopia, Iran, UAE, Indonesia. This will have important consequences for the future of the world. We will soon elaborate on BRICS Plus in a future video. Don't forget to subscribe.